What's interesting about investing, or even thinking about investing, is that most people would say, no risk, no reward. That's the phrase. That's the accepted saying. No risk, no reward. Like you got to be willing to risk losing in order to get a gain or a big gain. But in actuality, it's the exact opposite. Because if you think about Warren Buffett, he's like in the top five richest people in the history of planet Earth. And he puts his money less at risk than almost all of the other investors. So it's the least amount of risk equals the greatest amount of reward. You don't want to put your principal at risk. And so he waits until things are locks and cinches, and then he invests. He doesn't speculate. And his biggest investment by far, and the one that's made him the most money by far in actual dollars, is his investment in Apple, which he didn't make until 2018. Another way to think about it is, let's just assume you're buying properties at a tax sale. A lot of the most of the counties in the United States, in the individual states, they have tax sales. So if you own your house free and clear and you don't pay your tax, the house is going to come up. So people are going to bid on the house, and they're going to have a right to buy that. And so if you were buying houses at those tax sales, the least amount that you would pay would create the greatest gain. So the lowest you could get your cost, the higher percentage return you'd make over time. But most people, when they turn that back on stocks, they're always buying when everyone is really excited about it. So you're buying when the news is good, and they think that it's less risky at that point. But if you buy when the news is bad, the price will be lower. And the key is, if you're doing that, if you can buy when the news is a little bit bad and the narrative is wrong, as long as the narrative is a little bit better, if the company's actually a little bit better than the negative narrative, you can make a lot of money. But on the flip side, though, back to Buffett, if you buy a great company at a reasonable price, he always said that's far better than buying an average company at a great price. So there is a next level gear there, especially when you're talking about stocks, where the great companies really can hit high levels of performance, especially over time. So, but all in all, risk versus reward, that's misunderstood. If you're talking an extreme short time period, like if you're buying options that expire within the next week, and you're buying an option in a stock, well, in that case, risk reward comes into play, because you're going to have to risk money. And if it goes up between now and next week, you're going to make a lot of money. But in general investing, the least amount of risk that you can have, the better. And that's going to be over the long run. And usually over the short and medium run, the better. And you're going to make a lot more money with the least amount of risk. But when it comes to speculating, that's generally where risk equals reward. So if you were looking to invest in one of these miracle companies that every 10 or 20 years you get one of the all-time greats, like Google, years ago it was Microsoft. So there's a lot of venture capital companies that invest or speculate in those, but they don't put all of their money in one thing. They pick about 20 of them, because you don't know which ones are going to work out. So they'll put 5% of their money into each one as an example, and then hope and pray that one of them takes off and they can make a couple hundred times on their money.